In video lecture 2-2, we're going to address the question, what is GAAP? GAAP, of course, stands for Generally Accepted Accounting Principles. And GAAP is an area that is constantly evolving. It has many contradictions. It is partly broad-based, giving general guidance, except where it provides very strict rules. Many things that we think would be dictated by GAAP, like, for instance, the bookkeeping rules, are not. Other items are very extensively covered in GAAP, but apply to only a very limited group of entities. GAAP exists both in the United States and in international markets. And the rules and standards that were used in different capital markets evolved differently, had different socio-economic and political backgrounds. And recently there has been a move afoot to converge these. So defining GAAP specifically is very difficult. But let's take a look at a general overview. In the US, when we make a statement that something has been done in accordance to GAAP, that means it can be traced to the FASB codification. The FASB codification project took accounting pronouncements that were developed over a very long period of time by different bodies. They were amended, changed, added to, subtracted from, and put them all in one place and attempted to organize them. In class, we're going to be working through some exercises that will require you to access the FASB codification. You'll see the structure. These are the basic topic areas of the codification. In addition to the codification, standards that are issued by the International Accounting Standards Board apply to accounting rules in world markets. Again, the FASB, the US GAAP provider, and the IASB, the international standards people, are working on numerous joint projects that will attempt to converge the two sets of standards. Whether we ever have one set of standards is yet to be seen, but certainly there is a movement to make sure that as new pronouncements come out, the comparability between international standards and US standards are there. Let's look at the conceptual framework. The conceptual framework forms the basis of GAAP. It's the foundation or constitution. Whenever FASB studies an accounting issue, any standard that they are going to pronounce must meet the framework that has been established. And the framework has financial reporting objectives, talks about the qualitative characteristics of the information, the elements of the financial statements, and the recognition and measurement rules or concepts that are applied before we allow information to enter the accounting system, and when it is entered, at what value we're going to place upon it. And it also recognizes there are certain restraints. The conceptual framework begins with the objective of financial accounting, which we covered in our earlier video lecture, and that is to provide information that is useful in making investment and credit decisions. Qualitative characteristics of accounting information are split between the relevance of the information, and by relevance we mean the predictive value that the information has. Again, remember, users are taking historical information that are contained in the financial statements and using them to make future-oriented decisions. So the information we provide to users has to have this predictive value. In order to be able to compare entities or between each other or a single entity over time, the information has to be confirmable. That is, it has to be auditable. These two values, predictive and confirmable, have much to do with what is known as earnings quality, and that is something we're going to discuss later on in Chapter 4. Materiality means that the information has an effect on the user's decision. We'll be talking a lot about materiality. And again, the thing to remember about materiality is that it is a theoretical amount that would cause a user to change a decision. Faithful representation exists when information is complete, it's provided objectively, and free of error in an amount that would cause a user to change their decision. So there's a direct connection between materiality and free from error. If a large corporation makes an error in the amount of petty cash that it used for a period, it is doubtful that would cause any user to change their decision. And again, for information to be useful, it has to be comparable. That is, you have to apply on a consistent basis the same accounting principles, period after period. It must be able to be verified. That is, it must be auditable. It must be provided in a timely manner and in a way that is easily understandable. Now, in GAAP, we do not shoot for the lowest level of user, nor do we shoot for the highest level of user education when it comes to accounting principles. We talk about the understandability being based on somebody who has some background in business. All of these qualitative characters are constrained by the cost-benefit analysis. The cost of providing accounting information cannot exceed the benefit that it is going to provide. So we will not necessarily disclose every bit of information that is available. We have to make this cost-effectiveness judgment. The elements of the financial statements are the line items that are contained in each of the four statements. we've talked about assets, liabilities, and equity, both the investment paid in capital by the owners and the earnings that have either been distributed or retained in the business. And again, you see our very precise definitions of asset, liability, and equity. We have our comprehensive income. Again, these evolve out of non-owner sources, and these reflect the change in assets and liabilities that occurred over a period of time. We report comprehensive income both for the period and an accumulated amount that goes back to the beginning of the business. And you can see here we have our definitions for revenue, for expenses, gains, and losses that we spoke about earlier. And these are our elements of the financial statements. GAAP provides standards and guidance that allow us to do three things. Recognize when information is to be added to the accounting system and ultimately reported on the financial statements. Measure the impact of the recognition in the accounting information system, both initially when the recognition occurs and at a subsequent point in time. And then finally, GAAP standards tell us any additional supplemental information that we must provide the user. These are our accounting concepts. We make certain assumptions, for instance, that an economic entity is a single entity regardless of the number of legal entities that comprises it. What I'm saying is, for example, many corporations own other corporations. And if a corporation controls another corporation, even though they are separate legal entities, there is only one economic entity on which we will report. And we have our going concern assumption. The business will continue to operate indefinitely, that we can report in given time periods or periodicity. Our monetary unit, despite the fact that most U.S. corporations operate in many different markets with different currencies, all the amounts reported on the financial statements are in U.S. dollars. We'll be applying the historical cost principle, the realization, matching, and full disclosure. And we'll talk about this throughout our financial accounting courses. A critical thing to understand at this point is the revenue recognition rule, or the realization principle, and it states that earnings will be recognized when the earnings process is complete or virtually complete, and we measure virtually complete on the basis that we can make an estimate of the future costs associated and timing of when the completion will actually occur. And the collection of the asset related to the revenue is reasonably certain. The other key principle is the matching principle, which tells us when we're going to recognize expenses. And matching says that all expenses incurred in generating revenue will be recognized in the same period. Cost of goods sold is one of our expenses, and that is based on this first approach, a cause and effect. In our management accounting system, we capture labor, material, and direct overhead costs and assign them on a per unit basis. So we know the cost to produce 1 unit of merchandise. If we do not have an exact cause and effect relationship, we can associate them with a specific period of time. For example, if we have office workers, they cannot be directly associated with a unit of product, but we can associate their expense to the same time period in which revenue is being recognized. So, for example, accounting personnel, their cost will be considered an expense in a specific time period in which we're recognizing the revenue. We could have a systematical approach to allocating the cost of acquiring an asset over time, known as depreciation. And sometimes GAAP tells us that we cannot make a reliable connection between revenue and cost. Therefore, we must recognize the cost in the period in which it is incurred. And 2 examples of this are research and development and advertising. We don't know, for example, that when an advertisement is run on TV, whether it directly related to any specific revenue stream that occurred, nor can we make that match between research and development and specific revenue with any kind of real connection, real cause-effect relationship. So these are our 4 approaches to matching. More and more reliance is being placed on fair value. And when we talk about fair value, it is not necessarily market value. GAAP defines 3 levels of fair value. The most reliable is when we can place the measurement of an asset or liability on a market price that comes from an effective and active market. Sometimes we may not have a market for the exact asset or liability that we're talking about, but there may be a market for a similar asset or liability, and that's known as a level 2. At the bottom of our list is where we determine the value based on a discounted cash flow. And that is the inputs to the valuation equation, the future cash flows, and the discount rate that we are applying. The use of fair value leads to the recognition of other comprehensive income. Recently, within the last 20 years, FASB has switched emphasis from the revenue expense approach to the asset liability approach. In the asset liability approach, we are looking to value the assets and liability first and then recognize the impact of the change in assets or liabilities on the income statement account elements, revenue, expenses, gains, and losses. Under the revenue expense approach, the emphasis was on the recognition of revenue and matching with expenses. So as we go through our courses, we may see instances where GAAP will direct us to take a balance sheet approach. In other areas, GAAP allows an income or revenue and expense approach. And in other instances, they allow two different alternate methods of measurement. And in our next video lecture, we'll talk about an important area relating to accounting ethics.